In 2004, two co-workers each had $60,000. One of them bought a rental house. The other bought index funds. 20 years later, one of them is significantly wealthier than the other. But it isn't the person you'd expect. And the reason has almost nothing to do with which investment earned the higher return. It has everything to do with a single hidden factor that almost no one puts in their spreadsheet. We treat this like a war. Team real estate on one side, team stock market on the other. Each one convinced the other is making a terrible mistake. But the wealthiest investors aren't fighting that war at all. They're not asking which asset is better. They're asking a completely different question. And once you hear it, you can't unhear it. Because the moment you add in time, leverage, taxes, risk, stress, and the strange way humans behave with money, the obvious answer falls apart. By the end of this, you'll see why most investors have spent years solving the wrong problem. The myth that started the debate. Let's start with why this debate feels so emotional in the first place. Real estate feels safe. You can drive past it. You can stand in the doorway. You can put your hand on the wall and feel that your money turned into something solid. For generations, that feeling has been passed down like a family recipe. Buy property. They're not making any more land. A house is real. The stock market is just gambling for people in suits. Stocks feel like the opposite. They're abstract. They're a number on a screen that turns red for no reason you can see. So we trust the thing we can touch, and we doubt the thing we can't. But here's the quiet truth underneath all of it. We tend to judge investments by how visible they are, not by how well they actually perform. Owning a building feels like wealth. Owning a few thousand shares of 500 companies usually doesn't, even when it's worth more. That single emotional gap moves billions of dollars every year. And it raises an uncomfortable question. What if the greatest strength of real estate, the fact that you can see it and touch it, is also its greatest weakness? The rental property dream. Meet the first co-worker. Call him Daniel. In 2004, Daniel takes his $60,000 and puts it down on a $300,000 rental house. On paper, it's beautiful. The tenant's rent covers the mortgage. The house climbs in value while someone else pays it off. Every month, a little money lands in his account like clockwork. This is the dream that built 1,000 weekend seminars. Passive income, mailbox money, financial freedom with a key. Then the house starts talking back. The water heater dies in February. The roof needs $8,000 it didn't ask permission for. A tenant moves out, and the place sits empty for 3 months. 3 months where the mortgage doesn't care that no one's paying rent. Property taxes creep up. Insurance creeps up. One bad tenant stops paying. And Daniel learns that removing someone from a home he owns can take months and a lawyer. Here's what almost every new investor gets wrong. They overestimate the income and underestimate the cost. The rent is easy to picture. The repairs, the vacancies, the surprises. Those live in the fine print of real life. The lesson Daniel slowly learns is this. His investment isn't just generating money. It's demanding his attention. And while he's learning that the hard way, his co-worker is having a completely different experience. The quiet power of index funds. Her name is Maya. In 2004, Maya takes her $60,000 and buys a broad index fund, a single fund that quietly owns a slice of 500 of America's biggest companies. Then she sets up something almost boring, an automatic transfer. Every month, a little more goes in without her lifting a finger. Every dividend those companies pay gets reinvested to buy a little more. No tenants, no roof, no 2 a.m. phone calls. While Daniel manages a property, Maya's money manages itself. She's diversified across hundreds of businesses, so no single failure can sink her. She's compounding, so her gains start earning gains of their own. And if she ever needs the money, she can have it in days. But here's the part people miss. The biggest advantage of her approach probably isn't a higher return. It's that it asks almost nothing of her. It requires fewer decisions, and fewer decisions means fewer chances to make a costly mistake. There's a strange pattern in investing. The people who tinker the most, who buy and sell and chase, tend to do worse than the people who pick something sensible and then mostly leave it alone. Maya isn't winning because she's brilliant. She's winning because she's not interfering. But stocks have a weakness that real estate investors love to point out. And to be fair, they're not entirely wrong. The secret weapon called leverage. That weakness starts with a word: leverage. Think back to the two starting points. Maya's $60,000 bought her $60,000 of stocks. Daniel's $60,000 controlled a $300,000 house. That's leverage, a small amount of your own money controlling a much larger asset, with the bank covering the rest. Watch what it does. If Daniel's house rises just 5%, that's $15,000 of gain on a $60,000 stake. That's a 25% return on his cash from a 5% move. Leverage is how ordinary people turn a modest down payment into real wealth. But leverage has no loyalty. If that same house drops 20%, Daniel's entire down payment is gone, wiped out by a move that would barely register in Maya's portfolio. If rents fall or repairs spike, he's feeding a property that no longer pays for itself. If he has to refinance when rates have jumped, the math can turn against him overnight. So, here's the truth about the so-called secret weapon. Leverage doesn't create success. It magnifies whatever was already going to happen, good or bad. And yet leverage still isn't the biggest difference between these two investors. Something quieter matters far more. The cost nobody puts in the spreadsheet. Open any rental property calculator and you'll see boxes for everything. Rent, taxes, repairs, insurance. There's one cost no spreadsheet has a box for: the cost to you, the stress, the attention, the mental bandwidth, the low hum of one more thing you're responsible for running in the background of your life. Daniel's investment follows him. The text from the tenant during his daughter's recital. The weekend lost to a clogged drain. The decision fatigue of being a landlord, a repairman, and a debt collector all at once. Maya's investment follows her too, but only as a number she checks when she feels like it. It never calls, it never floods, it never needs her on a Sunday. And this is where the real bill comes due. It's called opportunity cost. Ask the question almost no one asks. What could those hours have built somewhere else? A promotion, if he'd poured that energy into his career. A side business, a new skill that raised his income for life, or simply more evenings that belonged to his family instead of his property. Here's the line worth remembering. Some investments cost you money, others cost you your life, and we almost never weigh the second one. Now let's talk about the math nearly everyone gets wrong. Why return percentages can be misleading. Both Daniel and Maya will eventually brag about their returns, and both will be telling the truth, while quietly hiding half the story. Here's how the trick works. A real estate investor will quote his cash-on-cash return, the income compared to the cash he put in, and thanks to leverage, that number can look spectacular. What he leaves out is the work, the risk, and the years a property sat flat. A stock investor will quote a long, beautiful chart, climbing from the bottom left to the top right. What she leaves out is the gut-wrenching drops along the way, and the stretches where her money went nowhere for years. Both camps cherry-pick. Each one picks its best decade and calls it normal. And almost no one talks about the number that matters most, the risk-adjusted return. It's a simple idea. It's not just how much you earned, it's how much risk and stomach-churning volatility you had to survive to earn it. An investment that returns 10% calmly is worth far more in real life than one that returns 12% while nearly giving you a heart attack twice. So here's the correction. The goal was never to maximize your return. The goal is to maximize your return relative to the risk you had to take. And this is exactly where taxes quietly rewrite the entire scoreboard. The hidden tax reality most investors ignore. Two investors can earn the exact same return on paper and walk away with very different amounts of money. The difference is taxes, and this is where real estate plays one of its strongest cards. Daniel can deduct his expenses and his mortgage interest. He can claim depreciation, a paper loss on a building that's rising in value, which lowers his tax bill on income he really received. And when he sells, a tool called a 1031 exchange can let him roll the gains straight into the next property and delay the tax bill, sometimes indefinitely. But Maya isn't defenseless. The dividends she earns can be taxed at lower qualified rates. If she holds for more than a year, her gains get the friendlier long-term capital gains treatment. Broad index funds are naturally tax-efficient because they rarely trade, and if she invests through a 401k or a Roth IRA, her money can grow with the tax drag reduced, or in a Roth, removed entirely. The point isn't that one wins, the point is that the headline return you see is a mirage. Your pre-tax return isn't your real return. Your after-tax return is. And yet, even taxes aren't the hidden risk most investors overlook. The crash test nobody wants to run. To find that risk, we have to crash both cars on purpose. And history already ran the test for us. The year is 2008. For Daniel, the housing crash is personal. His home's value drops below what he owes. He's underwater, holding a $300,000 mortgage on a house worth far less. He can't easily refinance, and he can't easily sell. Then his tenant loses their job and stops paying. Now he's covering the full mortgage himself on a falling asset, with foreclosure letters arriving in the mail. For Maya, 2008 is brutal too. On paper, her portfolio is cut roughly in half. The screen is a sea of red. Every instinct in her body screams to sell and stop the bleeding. But notice the difference in what each crash actually demands. Maya's loss is terrifying, but it's only real if she sells. Daniel's loss comes with bills that arrive whether he panics or not. So ask the questions that matter. Which investor slept better? Which one had the flexibility to wait it out? And which one was forced to make painful decisions at the worst possible moment? Here's the lesson the crash teaches. Risk isn't what happens to your investments during the good times. Risk is how you're able to behave during the bad ones, and that depends on something we haven't named yet. Liquidity changes everything. That something is liquidity, how fast you can turn an asset back into cash. Maya can sell her entire portfolio in seconds from her phone on a Tuesday. Daniel might need months to sell his house, plus agents, fees, repairs, and a buyer who actually shows up. And when life goes sideways, a medical emergency, a job loss, a once-in-a-decade opportunity that needs cash today, that speed is everything. Liquidity is freedom. But here's the twist almost no one expects. too much freedom can be dangerous, because the same button that lets Maya sell in seconds is the button that tempts her to sell at exactly the wrong time. At the bottom of a crash, when fear is loudest. Easy to sell means easy to self-sabotage. Daniel can't do that. He physically cannot panic sell a house at 3 a.m. Real estate's biggest flaw, that you can't get out quickly, quietly forces him to be patient. And patience, in investing, is often the whole game. So the strange conclusion is this: the greatest strength of stocks, instant access, can become a weakness, and the greatest weakness of real estate, being stuck, can become a strength. Which finally brings us to the question you came here for, the million-dollar question. After 20 years, who really won, Daniel or Maya? Let's run it with realistic everyday numbers, no fantasies. And a quick note, these are illustrative, not a prediction. Your numbers will be your own. Daniel's house grew at a modest pace and is now worth around $650,000. After 20 years of his tenants chipping away at the loan, he owes roughly $130,000. That's about $520,000 in equity, plus the rent that trickled in over the years, built from a $60,000 start. Leverage did real work. Maya kept it simple. Her original $60,000, compounding through every crash and recovery, grew to somewhere around $370,000 on its own. But she didn't stop there. She kept adding automatically, month after month. With those steady contributions reinvested for 2 decades, her total lands in the same neighborhood as Daniel's, and depending on the years, can quietly pass it. So who won? Here's the honest answer the gurus won't give you. Neither one wins in every environment. Change the city, the decade, the interest rate, or the tenant, and the trophy moves. The real result didn't come down to the asset at all. It came down to discipline, behavior, time commitment, income growth, the market they happened to live through, and the way each of them was wired. Which points to the most important sentence in this entire video. The best investment is usually just the one you can stick with for decades. What the wealthiest investors actually do now. Look at what truly wealthy people do, and notice what's missing. They're not in the comments defending a team. Walk into the life of almost any wealthy family, and you'll find the same thing. They own stocks, and they own real estate, and very often they own a piece of a business too. They're not trying to crown one winner. They're building several engines of wealth at once, so that when one stalls, the others keep pulling. To them, how you divide your money across different assets matters far more than loyalty to any single one. They don't see owning both as a sign of indecision. They see it as a sign of maturity. Which brings us to the truth this whole video has been circling. The truth: most investors miss real estate and stocks were never really competitors. They're tools. A hammer isn't better than a saw. It depends entirely on what you're building and who's holding it. The right tool for you depends on your personality, how much time you really have, how much risk you can stomach, your income, and what you want your life to look like. Which is why, which investment is better, was the wrong question all along. The question that builds real wealth is quieter. Which investment makes it easier for me to stay invested? Because in the end, compounding doesn't reward the smartest person in the room. It rewards the most consistent one. Most people spend their whole lives hunting for the perfect investment. The wealthiest people usually do something far less glamorous. They find an investment they can live with, and then they give compounding enough time to do what looks impossible. The investor who wins isn't always the smartest. It isn't the one with the most impressive spreadsheet. It isn't even the one who happened to pick the better asset. It's almost always the one who stayed consistent, while everyone around them kept changing their mind. So now, I want to hear from you. If you had to choose today, right now, would you buy the rental property or the index funds? Drop your answer in the comments and tell me why. I read them. And if you like financial deep dives that question the stuff everyone takes for granted, subscribe and stick around for the next one. Because getting good with money was never about getting rich faster. It's about making better decisions for decades.